Hi everyone, Fritz here, and in this video we're going to go over the difference between percent and actual return. When it comes to investing, there may be some terminology that you're unfamiliar with. Some of that terminology that we're going to go over today is percent versus actual yield. Some people have high claims of saying that they did 50% in the marketplace, and then other people say, well, I actually got $100 or $20. But what's the difference between that? Percent yield is the percentage in which that your money is growing, and that can reflect positively or negatively in the market. So if someone says, last quarter I saw all of my investments have 50% growth, that means it could have went 50% up or 50% down. Or half of his stocks could have went 50% up and the other half of the stocks could have went 50% down. So when someone says that they have big percentage gains or yields in the market, honestly, I'm not too impressed by it. And you shouldn't be either. It doesn't mean that they're unsuccessful, but what you should be more concerned with is what is their actual return. And actual refers to the change in dollar amount that they had in the marketplace. So again, if someone said, oh, I had 50% growth, but if they're only investing in penny stocks, that means they only grew half a penny. But if someone says, oh, I only had 5% growth, but they have a lot of money in the market, maybe that was $5,000 worth of growth. And in that instance, the person with the higher percentage actually had a lower return. So don't be too impressed when someone says, ooh, I know how to invest your money. I know how to save your money. I know how to grow your money because my clients, they see a 50% growth. You don't know if that's going up or down. You don't know which ones are going up and which ones are going down. You will always want to ask, what is the actual return? What is the money that is actually returning to them every quarter, every year, or whatever margin that you want to save your money in? You want to know what is their average rate of return. What is the amount of money that they're yielding back for their clients? So that's some of the terminology. If that didn't drive it home for you, hopefully this little diagram that I have here will. Let's say we have person A who has $100. That $100 in year one grows 50%, meaning that their total now is $150. In year two, let's say their investments take a hit by 50% again. Their $150 now becomes $75. All throughout that market change, their growth was 50%. Taking a look back at person B, who still has $100, same as person A, invested their money at 0% in year one, they keep the $100, and then in year two, again, there is 0% growth. They keep the $100. So although person A had a percent growth of 50%, person B, who had 0% growth, actually ended up with more money. The moral of the story is that percent growth is not everything. You really want to look at actual return. And when you're looking into investments, if you have money to spare, go ahead. A lot of people say, oh, younger people, they can take the risk. But when you really start looking into investments, if you don't want to lose a lot of your money, or if you don't want to risk losing a lot of your money, because no one wants to lose their money, of course, you're going to want to look into some things that have something called downside protection. That is what's going to make sure that you do not fall too low if the market crashes. And I don't want to be biased, so I don't want to refer one company or one investment over the other, but just introducing you to the concept of downside protection will help you save money in the long run. So if you found this video helpful, let me know by leaving a like and a comment down below, and I'll see you in the next video.